Hi, class. Welcome to lecture 3.2. This is essentially chapter 7 in your book, and it's basically based on bonds. Now, you see I've listed a whole bunch of practice problems. Obviously, they're there for you. They're not going to be graded, but I do think that these particular problems will help you understand bonds. You also have your test guides and a lot of other wonderful, helpful information. In fact, to give you a couple hints, let's move on to the next slide. As far as exam 3 is concerned, you really should focus on today's lecture. Today's lecture is going to be extremely important. In fact, most of the questions that I'm going to take from for the exam are going to come from this lecture and from your test guide. So it's really important that you pay attention to this lecture. 3.1 is not as important. You could probably even skip it and still be okay. It's just that I think that if you've never even heard of the term interest rate, you're going to want to, listen to that chapter 6 lecture so that you have a better understanding of what interest rates are, because they are very important, and they're also extremely important for understanding bonds. If you look at your test guide, you're going to have 40 questions. 30 of those are conceptual, and then you've got the 10 big math questions. What you can really expect is, most of the questions on the exam will look like the test guide, especially the math questions. The conceptual questions are just to give you an idea of what kind of conceptual questions I might ask. And as you will see through here, there will be a slide. I think I actually put it in here twice, called the bond cheat sheet. You really will want to understand that slide. It will help you a lot for figuring out, how to solve bond problems. Now, bonds and their valuation. So we're going to talk, if you can look up there at the top, you can see 4 different areas: key features, bond valuation, measuring yield, and assessing risk. Before we go there, though, you might ask, why do I care? Well, do you expect to ever take out a credit card? Do you expect to ever take out a mortgage on a house? Get a car loan? There's going to be a lot of times in your life where you're going to want to understand debt, and bonds are, for the most part, just a debt instrument. It's also important to understand from a macro perspective. Just here recently in July 2015, the national debt is, around 18 trillion 150 billion dollars. Okay, that's around $125,000 for each American household, or pushing $60,000 per individual. So if you think about that, $125,000 will buy you a house. So, but instead of getting a house, that's what you have to contribute to the national debt. Now, I do realize that the rich will pay more of this debt, but if you break it down, it is pretty impressive to think about how much debt we each owe for all the money that the federal government has been spending. And what's more important is how quickly this has accumulated recently. It took the country 205 years to accumulate its first $1 trillion of debt, which was in 1981. It has only taken 403 days to accumulate our most recent $1 trillion. Okay, so think about that. 205 years versus 403 days. I know it's really hard to think about some of these numbers, especially if you're not a numbers person, but if you were to sit down and count to a million, it'd probably take you at least 1 week. And if you wanted to count to a trillion, it'd probably take you 31,000 years. Let me repeat that. 31,000 years. Okay? $1 trillion is a huge number, but yet we spend it like it doesn't really mean much. And you heard me recently talk about interest, where we're already spending over $400 billion a year on interest payments alone. Let me repeat that. We pay $400 billion just on interest every year. That's $400 billion that could go to schools for education, maybe give you guys some more scholarship money. Could go to helping out the poor. It could go to, for better roads. It could go to our military or our veterans. But this is going, just to pay the interest on our debt. And this is going to get much worse. If you think about it right now, interest rates are, they're at historical low points, right? We're looking at somewhere around 2.53%. When these interest rates go up, our interest payments are going to rise, just exponentially. Thanks to that wonderful thing we learned about in our last exam called compound interest, right? So if we ever get to a tipping point where we may be actually spending more on interest than we are on even what the government's bringing in, that these are scary numbers to think about. So Now, obviously, we have some time, and we may be able to work out a situation, but the amount of debt that we've been taking out recently, there's no way we can sustain that. We're just not growing fast enough, and so that's some big macro issues. So there's some really important micro issues, personal issues, and some really important macro or political issues that we all need to understand to make sure that we are doing what's in the best interest of our family and our country. Okay. So to make sure we really understand what's going on, the first thing we want to understand are some key features of bonds. So what is a bond? A bond is a debt security that's used to borrow money, usually from a government or a corporation. In other words, investors are going to be the ones that buy the bonds, and they expect to get a specific amount of interest over time, and they want to get that cash they put up back as well, and it's called principal, and they expect to get that principal. It's usually $1,000 at maturity. So you give $1,000 over, get some interest for a while, and also get your $1,000 back at the end. In other words, bonds are usually interest only, meaning the borrower pays interest only but none of the principal. That being said, there are several types, and we will go over all the types as well. For example, one specific type of bond that you can get is mortgage-backed securities, and if you think about it, these are the bonds that got a lot of publicity because they helped contribute to the 2008 economic recession. And if you think of mortgage-backed securities, what are mortgage-backed securities? Well, mortgage-backed securities are you have an asset-backed security that is secured by a mortgage or a collection of mortgages. The big three, as far as mortgage-backed securities are concerned, the big three government-sponsored enterprise issuers are Fannie Mae, Freddie Mac, and Ginnie Mae. And these, there's also an issuer known as Sallie Mae, and Sallie Mae works with student loans. Okay, so most of these were created to help make, affordable housing for a larger percentage of the population, with the idea that the government would bear an additional amount of risk because, for the most part, these are government guaranteed securities. And we saw that recently when the government did bail out these issuers before they actually went bankrupt. If you want to learn more about mortgage-backed securities, I suggest that you look them up. There's a wealth of information online, and they're pretty interesting. They played a major role actually in the last recession and also in a lot of people's lives. I mean, mortgages are one of the biggest debts that the average American household takes on. Now, I've mentioned a couple big important examples about bonds, but let's make sure that, and bonds are obviously an instrument, debt instrument, but let's make sure we really understand the difference between debt versus equity. First off, there's really no ownership interest with debt. So debt doesn't, debt holders aren't really as concerned with whether or not the company's stock price goes up or down or how much profit they make, as long as they make enough to pay them back. This is obviously different. Shareholders are very much concerned about what's going on with the share price and the profit margins for a company. With debt, you have no voting rights, so you don't get a proxy for any kind of meeting. You don't really have much decision making powers, but you obviously have some say so if you're a major shareholder in a company, right? So common stockholders get to vote, and if you own a big enough interest in a company, then you would definitely want to vote or be participate in those meetings. Now, debt is also tax deductible, so a lot of times people will say, well, why would you even want to use debt? Well, one of the major reasons that you want to use debt is that you get a little bit of a tax shield from using debt, whereas with equity, neither the dividends nor the capital gains are tax deductible. Also, your interest payments are pretty much guaranteed, right? Unless the company goes bankrupt, and so this is a legal guarantee. Whereas even if a company's been paying 3% dividends for 25 years, they're not legally obligated to do that. So you have to be very careful with what you think is guaranteed income from equities, whereas it's pretty much for sure when it comes to debt. Also, debt, too much debt can be a bad thing, right? So, if a company gets in debt too much, then that can actually lead to bankruptcy. But the opposite's not true with equity, right? An all equity firm is actually in pretty good standing from a default perspective. It's not going to go bankrupt. But I do think it's important that we also talk about bankruptcy a little bit. With bankruptcy, debt holders will get paid off first before the shareholders, and so I think it's important to know that you kind of get in the front line if a company does go bankrupt if you're a debt holder, whereas you're in the back of the line if you're a shareholder. So these are the major issues with debt versus equity. The only other major things I can think of off the top of my head from my own personal experience is that the equity market is usually a little bit more liquid, and if you want to go buy a stock, you can go get a stock really, really fast. But when I was buying bonds, it was a little bit more like a used car lot, so you'd go there and you'd want to get a whole bunch of different bids and make sure, because they might not be priced as efficiently as stocks are, but the stock market is extremely, extremely efficient, so stocks are very, very liquid. So this brings me to my point about bond markets. Okay, so there are a couple major points I want you to get from bond markets. Most bonds are going to be traded in the over-the-counter market. And when I was a bond trader, one of the things that I talked to specific brokers, and I'd call a couple different and get, like I said, my best price, and then I would pull the trigger. But I would be buying not just one bond at a time. I would usually be buying like $1 million worth of bonds at a time, and usually these bonds are bought in increments of $1,000, right? So you know the bond market is actually much bigger than the stock market, but it's usually owned and traded just among the large financial institutions, right? The big banks and the big brokerage companies. And I would follow, throughout the day on my Bloomberg terminal all the news, and obviously, the Wall Street Journal and other news outlets would report on key developments in the Treasury, corporate, and municipal markets, right? So, there are different key bond markets that you want to pay attention to. And I was, specifically working for a bank, so I was mainly interested in investment grade bonds, bonds that had really high, debt ratings. And we'll get more into that and what's the difference between investment grade bonds versus speculative bonds later in this lecture. Now, there's some basic features of a bond that you really have to know. So you really need to commit some of this terminology to memory. Par value, for example, is the same thing as face value, or on your calculator it's going to be future value. It's the face amount of the bond, and so you're going to, if this was a brand new issued bond, you'd probably pay $1,000 up front, and you'd get that $1,000 at the back. Now, most of the time, if you got on bond market, the bond's not going to be exactly $1,000. It could be worth a little bit more, a little bit less. If it's worth more, then we usually call that a premium bond. If it's worth less, we call it a discount bond. But we'll get more into that. But really, you got to think about par value as $1,000. Okay. And then you have the coupon interest rate, or what I'd usually just call the coupon rate, and it'll tell you exactly what you should expect from an interest payment, right? So you take that coupon rate and you multiply it by the par value, or $1,000, and that's how you get that's how you'd get a coupon payment, right? So if your annual coupon rate is 5%, then you're talking about $50, right? And if it's a bond that pays twice a year, then you're talking about $25 semi-annual coupon payments. The maturity date is going to be your end value here on your calculator, and it's the number of years until the bond must be repaid. The issue date is just going to tell you when the bond first came out. And then the yield to maturity, this is going to be similar to your I button on your calculators, is the rate return earned on a bond that was held, assuming it's held until maturity, right? In other words, this is what you're supposed to get, right? It's your promised yield. This is also equivalent to your APR, which we've seen before when we were talking about APR versus EAR, and also because this is supposed to be up to date with the market, it'll tell you basically what you should be expecting from current market interest rates. So if you can figure out the yield to maturity on any bond, that is also what current market interest rates should be. Okay, so now that we've gone over a few terms, let's look at a specific bond quote. So what are we really looking at here? What company are we looking at? We're looking at ABC. Now, they may have just using ABC as an example, but that is an actual real company. It's called AmerisourceBergen Corporation. It's in Chesterbrook, Pennsylvania, and it's basically just a drug wholesale company. So what is the guaranteed interest rate or the coupon rate? Well, that's going to be that next number, your 8.375, so 8.375%. So if you think of about $1,000 par value, then the coupon payment each year is going to be, just move that decimal over one spot, $83.75, right? When does this bond mature? That's the next number. It's going to mature July 15th, 2033. What was the trading volume? That's the next number, 100.641. What is the quoted price, which is known as the ask price? And that's, whoops, and I can see that I just made a real quick mistake. Sometimes these get ordered in a slightly different way than I was expecting. So you can see here that the trading volume is actually that 763,528 number, which makes a lot more sense. And the quoted price there of 100.641, what does that mean? Well, that's telling you as a percentage of par. So the actual price here is then not $100, right? Multiply that by 10 because it's a percentage of par, and what you're going to see is that it's currently selling for $1,006.41. And then you get, how does the bonds yield compared to a comparable Treasury note bond? Well, what they have there is that 8.316 is going to be the last yield, and then 362 is going to be the basis point difference versus the 30-year Treasury bond. So there's a whole lot of information here. What I really want you to get is to know that you're going to get the ticker first, and then you're going to get the coupon rate, and then you're going to usually get the maturity date. And that's really what you're mainly looking for, and you're going to have to get some kind of a price, and usually they're going to quote that as a percentage of par. The rest of the numbers are often useful as well, but they can show up sometimes in a slightly different order. This is how you would see it usually for like a corporate bond, and then you might see it differently for a Treasury bond. For example, here's a quote for a Treasury bond, and what you're going to see is that the information is in a slightly different order. 2020, what does that mean? That's when the bond's going to mature, right? February 15th, 2020. What's the coupon rate on this bond? That's going to be that 8.5% number. What is the bid price and what is the ask price? Okay. So those are going to be back to back. And then how much did the price change from the previous day? And so you got that plus 64 there. And then what is the yield to maturity based on the ask price? Okay, that 3.4730% number. So let's look at the next slide, and I'll lay all of that out for you exactly. All right, so we've already obviously identified the maturity and the coupon. Let's talk a second about the bid price versus the ask price. Now, the bid price is the price at which the dealer is willing to buy from you, whereas the ask price is the price at which the dealer is willing to sell to you. And that difference, why is there a difference there? Well, obviously, that dealer wants to make a profit, and that's called the bid-ask spread. Okay. One interesting thing about bonds is that the investors here are somewhat more traditional, and although a lot of prices for a lot of markets have gone to complete decimalization, bonds are still usually sold in fractional numbers, and they're sold not in by halves or fourths or eighths or sixteenths, but by 32 or 30 seconds. Okay. So if you see here this change, that's what they mean here. What the change is saying is that this change is 64 over 32, okay? Or 32 is the tick size. Once again, the tick is the the amount a price can change, right? So prices here are going to change in some kind of a fraction of 1 over 32, right? And the yield based on the ask price is 3.4730%. Okay, so there's all that information you need there. And, once again, what we're really looking for like a lot of the math problems that we're going to be dealing with is price and coupon rates. You get you'll need the maturity date to figure out N, but start thinking about where different things are on your calculator. To help all of you out, I created this slide called the bond cheat sheet. if I were you, I'd print out this specific slide and keep it with me. Not only while you're taking the exam, but while just while you're doing everything, right? Sleep with it, put it, underneath your pillow. This is really going to help you learn how to incorporate what you learned from the last exam to bonds. So basically, you're going to use the same buttons that we did in the last class, your time value money buttons, which I highlighted there with that red box. But the terminology for them has changed somewhat. So this bond cheat sheet is almost, it's like having your own financial interpreter, right? It's a little bit of a different language. For example, if you look in that one column that says old TVM, old time value money buttons, you see N, you see I, you see PV, you see payment, you see future value going down that column. You should all recognize that column. The new time value money, meaning this is what you're going to hear when we're talking about bonds, but it's really just those buttons on your calculator are periods, usually semi-annual periods. Most bonds are either annual or semi-annual, and the vast majority of them are semi-annual, which means twice a year, right? When it comes to interest, you're going to hear a lot about yield to maturity. And the thing you're going to want to know about your interest as well is that that'll tell you what you expect to get on a bond if you hold it to maturity. But that's also the same thing really as APR. And once again, if you can figure out what a bond's yield to maturity is, you also should know what current market interest rates are as well. Okay. Price. Now, if you think about price, that is nothing more than the present value button on your calculator, right? So if you're given the price, you'll plug that in for PV, and if you need to solve for price, then you would obviously solve for PV. So that's what the bond's worth today. Payment, we've talked a little bit about coupon rates. Well, you use that coupon rate to figure out your coupon payment, right? And so, I could have written coupon payment there instead of just coupon, but I like to just say coupon, and I usually denote that with a C. Okay, so and then you get down to future value, and future value is the same thing as par or principal or face value, right? And so let's talk about what these actual amounts represent. Well, in an annual perspective, your future value, which we just talked about, is going to be $1,000. It's going to be $1,000 no matter what, whether you're talking about an annual bond, a semi-annual bond, whatever. It's going to stay the same. Price is going to stay the same as well. Now, you don't know what that is unless the bond was just issued, because when a bond's just issued, it's usually issued at $1,000. But then based on what happens with interest rates, that price could go up or down. You're going to be able to figure out the coupon payment pretty easily. If it's 5% coupon rate, then your annual coupon is going to be $50, right? So you figure out that annual coupon, which I have as a C with a subscript capital A, equal to CR times par. All I did there was take that 5% times 1,000. That's the $50. Now, if it's a semi-annual, then what you're going to have to do is divide that number by 2, right? So it would be $25, right? $25 twice a year. With I, your yield to maturity is just whatever you figure out your yield to maturity at. That you want to usually have that in terms of an annual amount, but if you're solving for a semi-annual bond, you're going to have to divide by 2 as an input. Now, if you solve for yield to maturity, it's a semi-annual bond, then it's going to come up as a semi-annual yield to maturity, and you'd have to multiply by 2 to get the annual yield to maturity. The same situation is true with N, except it's kind of, remember, N is almost like opposite of I as far as the math. If it's years, you're going to put it in as years, no big deal. If it's a semi-annual bond, you're going to have to take years times 2. So if it's a 20-year bond, that would be 40 periods, semi-annual periods. And if you solve for N with a semi-annual bond, it's going to come up as semi-annual periods. So then you would have to divide that number. So if you solve and you got 40, you'd have to divide that number by 2 to figure out this is a 20-year bond. Okay? So that all helps you, understand those last 4 columns. That first column that says sign convention is going to be extremely important with bonds. Beforehand, you really probably didn't get very many of your problems wrong if you were mixing up your sign convention. But with bonds, it's extremely important because you've got 3 different numbers here or signs you've got to get right, which are present value, payment, and future value. Let's talk about each one just to make sure that makes sense. Within, unless you're thinking about inventing some kind of a time machine or something like that, we're going to keep in positive, right? Can you have a negative interest rate? Technically, probably, but we don't really want to think about that as far as this class is concerned. For all the problems in this class, think of a positive interest rate, okay? Unless it tells you otherwise. For present value, this is really going to just make your life a lot easier if you always, always, always just make your PV negative. Okay, just assume you're handing over cash to buy a bond, and then that you're going to get a positive payment back, and then you're going to get the principal back as well. Okay, and if you'll just always make PV negative with a bond, and then make your payment positive and future value positive, you'll be just fine. Okay, so this is an extremely important slide. You may want to go back and listen to that over and over and over again until you understand the bond cheat sheet, because if you get the bond cheat sheet, you're going to really do well on this exam. Now, there are a couple other terms that you really need to make sure you understand, and we're going to go over each one of those. There are three important rates for bonds. We've already talked about two, right? We talked about yield to maturity, which is your I button. We talked about CR, which is your coupon rate, which helps you figure out the coupon payment, which is your payment button. And then CY. Whoa, what is CY? CY is not one of your buttons on your time value of money row. CY stands for current yield, and your current yield is similar to the coupon rate. But what your current yield is it's your annual coupon divided by your price. So it's more like taking that annual coupon and dividing by PV instead of dividing by FV, right? And so make sure you're using your annual coupon and that you're dividing by the price. And this is basically telling you what you're getting now, right? Your current yield. Now, some of you are probably asking the really big question is, why does the price change? Why is your price not always $1,000? Well, one of the big important things you need to understand about bonds is that the bond prices are going to change with interest rates. In fact, they're going to change the opposite direction of interest rates. So as yield to maturity or current market interest rates goes up, prices will go down, and as that yield to maturity goes down, prices will go up. Okay, and that's a really, really important concept. And to explain that, I could do that very easily with, let's take two students in the class. Okay, let's take Sally Sue and Marky Mark. Okay, now Sally Sue has a bond that pays 5%, and it's worth about $1,000, or at least that's what she got it when she that's what she paid for it. Okay. And current market interest rates were 5% when she bought it. Now, if market interest rates go up from 5% to 7%, what's Marky Mark going to do? Is he going to go to Sally Sue and buy her bond? Well, he's not going to want to pay full price for that, because he could go out and pay $1,000 and get a bond that's going to give him 7%. Okay. So he'll go maybe to Sally Sue and say, you know what, your bond's only giving 5%. I'm not going to give you $1,000 for it, but I might give you less. All right, and then the exact opposite would be true. What if Sally Sue's was holding her 5% bond, and then all of a sudden the markets dropped to 3%? Okay, well, then Marky Mark would really, really want Sally Sue's bond, right? Because it's giving you 5%. So he may go to Sally Sue and say, hey, here's $1,000. Can I have your bond? But Sally Sue's going to say, well, it's paying more than all the other bonds are out there, so I'd like you to pay me more than $1,000, right? So if in that case, that bond would be worth more, and that's called a premium bond. So if the bond price goes below $1,000, it's called a discount bond, and if the bond price goes above $1,000, it's called a premium bond. And there are some relationships between these three important rates that you should need to know, based on whether you're looking at a par value bond, meaning a bond that's selling for $1,000, a discount bond, or a premium bond. So at par value, all three of these rates should be the same: yield to maturity, the coupon yield, the current yield, and the coupon rate. They should all be the exact same. With a discount bond, meaning your price is below par, the yield to maturity will be the highest, and then next will be the current yield, and then the coupon rate. And then if you have a premium bond, the yield to maturity would be the lowest, the the coupon rate would be the highest. Okay. Now, it's very important to understand this. How would I ask a question like this? I give you a very good example of this with problem number 31 on your test guide, so make sure you take a look at it. Now, this next slide here, the value of financial assets slide, it's probably not going to be that important for most of you. I really stress the importance of that bond cheat sheet and all the information we just went over. But if you want to see a timeline, see how you might go about valuing a financial asset, this is really important, and we got a graph here that might help show it as well. So if you look here specifically at figure 7.1, the timeline for Allied Food Products bonds with a 10% interest rate, what you're going to see are all the specific payments and how they were discounted in, back to the present value. And so if you look, that first payment was discounted from $100 to $90.91, so it didn't have to be discounted that much because it only went back one period. But as you go down, each one's getting discounted back from a further point in time, so it's going to be worth less, except for that last payment. That last payment, if you look, is $239.39. Why is it the biggest payment? Well, if you look, it's got two little arrow points there, and that's because you got not only your $100 back, okay, but you also got that $1,000. And so if you look, that last year, or that last payment, you got not just that $239.39, but you also got a payment for $23.94. Okay, that $23.94 represents the $100 interest payment discounted, all the way back, and the $239.39 represents the $1,000 par value or principal discounted all the way back to present value. If you add all those payments up, then what you have there is $1,000. So, in this situation, the present value of this bond is $1,000. Okay, so now that we've kind of gone over some of the math involved with bonds, which, by the way, once again, I stress that's really going to help you a lot with the math problems on the test guide. Let's talk about a few more features of bonds or different types of bonds. The first one is the bond indenture. And that's really just the contract between the bondholder and the issuing company. It's referred to often as the deed of trust. It's going to lay out all the basic terms of the bonds, the total amount, whether it's secured versus unsecured, if there are any sinking fund provisions. It's also going to talk about any kind of call provisions. We won't get too much into some of these nitty-gritty details of bonds. I just kind of want you to know the basic definitions, which you obviously can look up. It's also going to list if there's any details of protective covenants in there. So if I go over any of these definitions here too fast, you can obviously look them up. That's basically all I want you to know. Let's start with the difference between a secured bond and an unsecured bond. Okay, so a secured bond is going to have some kind of collateral backing it up, very much like with a mortgage. The house backs up that mortgage as collateral, right? Or with a car loan, the car is often the collateral. But with unsecured debt, that is basically just based off the reputation of the company that issued it, and credit ratings obviously matter quite a bit, and that's obviously true also with with a lot of government debt as well. A sinking fund provision is a provision that requires that part of that principal repaid each year as well as the interest. And maybe one of the best examples here is very much like a regular 30-year fixed rate loan on a house, right? So a mortgage, because usually what you're trying to do there is pay not only the interest but also pay a little bit of your principal back. Eventually you're paying more principal than interest, but you're trying to pay it all back over time down to zero, and so that there's not this big payment at the end, right? Now, the difference between a sinking fund provision, though, and your typical mortgage is a lot of times you're setting up like a side account here where they're just the issuer is having to put money into that little fund on the side that shows that they're contributing to paying back that principal down the road, and that money can often be invested in something as well. But that way, if a company ever fails to meet this sinking fund requirement, that's usually going to be a sign that something's wrong with the company, or it could even trigger a default, which could even throw that company into bankruptcy. So think of a sinking fund provision as a mandatory payment. In most cases, the issuer can handle a sinking fund payment in one of two ways. The first way is that the company can call in for redemption at par value that required amounts that they're supposed to get within the bonds, right? So if they have a $1 billion issue and they're required to buy back say $50 million bonds, $50 million of bonds each year, then